All right, welcome everyone. We're going to be doing an Ask Me Anything. This is the text version. So I'm going to be answering your questions here that you've wrote in to the Discord chat. This is the Ask Me Anything channel. For those of you new, we've had a lot of people join. You can just ask about any subject here and I'll try to give you an answer. So let's go ahead and start off here with the most recent. Hey Joseph, thank you for all your work. Have you considered a review on the return on capital employed to include buybacks and dividends, for example, Google? Similar to your video on AutoZone on December 20th of 2022. Yeah, that was a fun video to kind of break down the overall returns of a company. I think it's an interesting exercise. I haven't done that with any other company. So no, I haven't done that yet. Maybe I will in the future. Would make for an interesting video, but I don't think it's super important, but I'm not ruling it out. Hi, Joseph. Can you share your thoughts on LVMH? Louis Vuitton, I think that's that one. You know, I like these companies. They're around for a long period of time. They seem to have significant moats, but they're not the moats that I look for. I don't look for moats that are brand value. And I've said this before. I think brand value in and of itself is a good moat, but of the really, truly great moats, brand value is one of the weaker ones. For example, I think network effects and how embedded a product is are significantly stronger moats. So you can take the counterexample of Facebook. Facebook had negative brand value. It was toxic. People looked at Facebook and, ew, Facebook. It got to the point where it was just full of Congress and had election interference, and it was politics and arguing and monetizing engagement and problems with kids and access to accounts and, just so many negative things tied to Facebook. Look how big that company is. They actually had to ditch their brand Facebook and rebrand to Meta. Part of that was to get rid of the baggage, yet that's one of the most profitable and continually growing companies in the world because it has the moat of being deeply embedded in everyday processes of people's lives. And it has massive network effects, which means the more that someone uses something, the more likely someone else is to use that thing. So if I have to pick, I'm always going to pick the brand value is not going to be the biggest moat. I'll pick Costco, which is just value, the value proposition to the consumer, over Nike, which is the brand value and convincing you to pay more for the money. I'll pick Meta over Louis Vuitton. I'll pick these different companies. Now, my favorite is if a company has these other moats like network effect, and it also has positive brand value. That's like Costco. That's the best of both worlds. You have a great brand. Kirkland's Signature is a fantastic brand. Costco is a fantastic brand. And it has all these other huge moats outside of that. Okay, moving on. Hi, Joseph. Given your long-term investment philosophy that focuses on high quality and predictable companies, I'm curious about your thoughts on bonds. With the recent rise in long-term bonds, yields above 5%, is there a specific yield threshold at which you would consider adding bonds to your portfolio? Would you buy a hypothetical U.S. Treasury bond yielding 20% today? I sure would. That'd probably be actually a bit past the threshold. I'd probably buy them if they're at like 10% or more. If they get up to 10%, I mean, stocks are great. I probably will earn a higher return with stocks, but a 10% treasury, I would start buying. I'm not going to buy 5%. I just think that I can earn a lot more than that in the market today. But if you doubled it, if you gave me 10% for US treasuries, I would start buying them. So, and that would probably be around the cutoff. It'd be like 8 or 9% to 10. That's probably where I'd start buying them. In truth, bonds, treasuries are a different thing because they really don't have a chance of failure in the typical sense a normal bond does. But the way that I look at my companies is very similar to buying a bond. The difference is with a bond, it tells you how much it's going to pay you. With a company, it does not tell you how much it's going to pay you in the future. They can have estimates and forecasts, but it's your best guess as to how much you're going to get paid. The benefit of a company, a stock, is that over the next 10 years, the amount that they pay you can increase over time. You get rewarded as the company does better. With bonds, that's not the case. If the company sells you a bond and you buy You buy a corporate bond. If the company does incredibly well and grows 5 times the size, they're not going to pay their bondholders anymore. So you don't share in any of the upside. At best, you can hope to get paid what you're owed from the beginning. So I like the dynamics much more with companies. I like the upside. I like that Netflix can go from $230 when I was bullish on it, now to $1,200. You're never going to see that with bonds. You just never have the same dynamic. Companies can 7x earnings, 10x earnings. They can grow their earnings per share and their free cash flow multiples and multiples. You do not have that dynamic with bonds. So I think equities are always going to be a superior vehicle to bonds, but that's at a certain threshold, the calculation shifts, especially for treasuries, because as much as the rating agencies, Moody's and S&P Global downgraded it, the U.S. is still probably the most credit-worthy thing in existence today. So yeah, 10% would be about my line. Can we please share your thoughts on AppLovin? I don't have any big thoughts on this one. It's interesting, fast-growing. I don't understand it as much as I would. I think any company like that's in one niche product that grows that fast is inherently risky. Also, can you please show us how you would use DCF calculators to determine a price point you would consider starting a position in Spotify, Shopify, FICO, and CrowdStrike? I have done a video like that before. Maybe I'll do one in the future. I don't have time in a typical AMA setting, but I've done it for Spotify. What I do with my discounted cash flow calculator, in fact, maybe I'll just bring it up here on Spotify. Let's bring it up. Let's go to the DCF. We'll go to Spotify here. I'll zoom it in so you guys can see it. And let's switch it to dark mode because Discord's a little bit dark mode. There we go. Now, here's what I do is in cases like this, with Spotify, I would type in numbers like this: 30% earnings per share growth rate and a multiple of 30. And that gives me a 2% annualized return for the next 5 years. And that's what keeps me out of it, is when I put in these big assumptions, 30% EPS growth, 30 multiple, I still get a 2% return. I'd have to buy it at $3.50 and Spotify's at $6.30. So I could go, 35 and take a look at that. That's looking better. I can go 40. Yeah, I can start bumping it up a little bit more. I can say, hey, what point do I need to get my 15% return? Okay, so 47% growth rate over 5 years and trading at a 30 PE ratio, I get a 15% return. Now, this is what I try to look at. It's a reverse discounted calculator. I look at this and I think the assumptions are pretty aggressive. They're pretty aggressive. And I don't want to make this aggressive of assumptions in a brand new position, because I think it puts me in a tough situation where I need only the best outcome to happen for me to get a semi-attractive return. Whereas there's other companies in my portfolio that I have to make nowhere close to these type of aggressive assumptions to have a very good return. Like, the obvious one. Let's go ahead and take a look at Google. Google, I can say, let's say it grows at 17% earnings per share growth and it trades at a 23. This is less than half the growth of Spotify and a multiple that's way lower. And I get a 21% annualized return for 5 years at today's price. Just incredible. I'd have to pay $224 to get a 15% return. So that's the type of calculations I'm running. From these calculations, you factor in quality of the business, and then you make judgment calls, make smart decisions. Try to determine which one of these has a better risk-adjusted return, which one has more asymmetry in the upside and downside, which one are you more likely to lose money, which one are you more likely to make money. Those are the type of things I'm doing. So that's how I use the discounted cash flow calculator. It's a sanity check. It lets you look and reverse calculate a lot of scenarios to see what type of judgments you want to make. Hi, Joseph. I'm a new Discord member, but I've been following you for a very long time, like 5 years. Yeah, that's a while. I appreciate you following for that long. I've watched every single video from your channel and have recommended you to multiple friends of mine. I've learned so much from you. Thanks for continuously sharing your insights, and please keep up the great work. I appreciate that. The question is, in my honest in my honest opinion, you have a very good investment philosophy, methodology, and temperament, and your investment performance history has proven it out well. I generally think you're better than many fund managers out there and even some of the super investors. Have you thought about becoming an actual fund manager to help people with their money/investment in a more direct way? If no, what's preventing you from doing it or moving towards that direction? Sure. I have the opinion that I really think retail investors can become better investors than many of the hedge fund managers. I think you've been told a lot of lies that because they have Bloomberg Terminal, because they have a team of 20 people working for them, you can't possibly put together a better portfolio or have better investments than they do. That's a common market efficiency hypothesis. It's also a self-defeating way of looking at it, when in reality, good investing is highly based off of flexibility and temperament, your ability to make sound judgments, change your positions, and have the temperament for long-term shareholder. And that's the opposite of what many hedge fund managers have. Not all of them, but many of them. Many of them are trying to do two things at once. They're trying to market their fund, meaning advertise it so they can get assets under management, and they're trying to run the fund at the same time while managing that whole relationship business of attracting assets, because they're all competing with each other for each other's assets and for investors' money. I don't have to compete for other investors' money. I don't have this whole portion of trying to attract assets under management. Now, when you attract assets under management, you have to have a sales pitch. You have to show why you're worth paying over the QQQ or the S&P 500. So you might want to avoid the top positions in the QQQ. And those are the type of reasons they underperform. I don't have any of these alternate incentives or perverse incentives, so-called. I don't have any restrictions with when I can sell and when I can buy. I'm very flexible, and I believe I have long-term temperament, and that gives you an inherent advantage. And a lot of individual investors have that. So when I look at this, I think there are many advantages retail investors have over these super investors or hedge fund managers that they can use. The reason that I haven't done this is I think it would add a great deal of stress to my life, because right now I'm managing my portfolio for me and my family. And I take that seriously. There's a great deal of responsibility. I want to do really well. And I also realize that there's a lot of people that are going to be observing it and looking at it and maybe taking some insights from my investments as well. But I'm not directly controlling other people's money. And going that far is a whole other degree of responsibility, especially because hedge fund managers in many cases only allow these what are they called? The approved investors that have like a net worth of over $1 million or make $300,000 a year. They have all these criteria, and that makes it so that they don't really attract retail money. So if they lose money, they're usually losing money of accredited wealthy investors. Most people that watch me, there are wealthy people and accredited investors that view my channel, but the majority of people are just normal people managing their portfolio for their family. And I don't want to manage thousands of people's portfolios for their family and fill that weight. I think it would be a lot of weight. So the money would be good. The best way to make money in finance is by managing money, because you get the MasterCard Visa way of doing business, where you earn a percentage base off of other people's money and business. That's a very attractive business. I'm going a little bit harder of a route with Qualtrim, developing something and selling it. But I think it's a good way to go. It's less stressful for me. Hi, Joseph. Trying to get this one across again. Wanted to know your opinion on Unity. That's Unity's the game developer, right? I know, a bit of a controversial one, as it's gathered some hate from the dev community. I've entered a position at the lowest sentiment point, as I think it has potential for a turnaround. One of the biggest factors of Unity's downfall was poor management and decisions that they deserved hate. Monetization policies and changes that made no sense. Yeah, they're the ones that were like saying that they're going to start charging their developers for every download of a Unity project or something. Just insane monetization strategy. You say that they've changed leadership. They've hired an all-star CEO, Matthew Bromberg, which has already made some good changes, in my opinion, reversing the screw-ups from the previous CEOs. That was one of them. You think this has potential for a turnaround? My average price is $17 to $18. You're going into this one a lot more detail than I'm familiar with. I just haven't looked over Unity. I'd have to give this one like a half-hour rundown to really get in the loop of what's going on with it. In general, yeah, I think if a company has really good assets and it has the ability to be turned around, those can be very attractive. They're not the ones that I seek out. So you're not going to see me doing a ton of turnaround plays, but I'm not saying they're bad. And investors like Peter Lynch, he loved turnaround plays. A stock that had terrible sentiment, everybody hates it. They get new leadership, but they have great assets underlying the company. He was really drawn to those type of situations. So even though I'm not totally uniquely familiar with Unity, if you have inside knowledge of what's going on, or not inside knowledge, but just in-depth knowledge of what's going on, how the CEO is going to change things to bring better business and grow earnings, and especially change the sentiment of the company, you have a good option there. Moving on, what advice would you give, given that we are targeting concentrated portfolios here? What if a situation happens like United Health Group or Novo Nordisk? I think that's NVO. Recently, or Meta in 2022, which are already relatively high quality companies with a solid moat that can go down by 60% and not recover for years. How does one manage that risk? Since the PEs of quality companies are high, if there is a PE compression, the price collapses. Any advice? Sure. So in the case of these companies that were previously like compounders and high quality, and all of a sudden they're multiple compresses, I think what your goal as an investor is to separate long shelf life problems, fundamental problems that bring in real terminal risk. Terminal risk means like things that can really long-term inhibit a company from ever having the same prospects it had prior. So those are real things. The market's dynamic, and those can happen. But there's also many cases where a great company goes through just a temporary troubling time that lowers earnings, and many investors that want to just go on to the next thing that's going up today abandon a company, making for a big opportunity. So I'm not familiar with MVO as much in terms of why it's going down, but I did cover United Health Group. My assessment of the company was that it was going down because of this Medicare plan where they gave all these plans. They assumed that they'd be utilized at a certain rate, and they were utilized far greater than what they assumed, making it so that they had to pay the difference in between, making it so that they had a lower guidance. They actually just scrapped that guidance and said that we're going to earn way less money, $5 per share less than we expected. And on top of that, you throw in some just general dislike of the company, the CEO changing, investigations being rumored, all of those type of tangent type of things around the company. And there you have a nice mixture of a company that was previously just really well thought of in terms of investors, and now it's struggling. And my assessment is that this is mostly temporary, that the problem, especially with their pricing, as they rolled into this problem, they'll roll out of it over the next couple of years. So 2 to 3 years, their earnings it'll normalize over time. This is not a terminal value risk. It's not something that will destroy the company. And those are the type of plays that I think are better to get into. So I do think that United Health Group, as much as you may hate this company or the insurance industry or what have you, it's likely undervalued. I think 3 or 4 years are going to see it much higher. You say one more question. Can you give us a reasonable bull case for U.S. debt for the next 30 years? Can you be anti-Dalio? Sure. Sometimes I pick fun at Dalio a little bit. I hope I don't go too hard at him. He seems like a nice person. And I bought his book, so I'm supporting him that way. But Dalio is someone that he's selling a message, and the product is, be prepared for the worst. And that's this whole hedge fund. That's what it's all geared around, weathering through the worst situations and this whole global order change and all of that. Now, the bull case for the U.S. debt would be that as of right now, all of this is still under our control. we can, first of all, the US has incredible assets that could be monetized. There's so many ways for us to make money with the amount of things that we own, the amount of things that we produce, even the US government, the different ways that the US government could bring in revenue. It's like there's a lot of untapped ways to do that. So we could grow revenue much faster than we are right now by monetizing a lot of the things that we aren't right now. On top of that, one of the things that needs to happen likely, this gets into some politics, but we need to simply just cut budget. I was originally, well, I'm still in favor of cutting waste, abuse, and fraud. So things where we're just paying people we shouldn't. We have bills the government's paying where there's no items or descriptions attached to it. All of that's good to cut down on inefficiencies, waste, abuse, and fraud. With Doge, that was the effort behind it. But I think it's increasingly clear that's just not enough. We need to just cut spending. We need to change the way that we're paying Social Security and Medicare. And those entitlements, if you're a politician going out and saying, hey, all the baby boomers, we want to give you less than what you paid in. You're retiring too early. You're living too long. You're taxing the system too much. We can't afford it, right? Nobody's going to give that message. They'll just never be elected. They'll miss the whole cohort. And nobody also wants to say, hey, young people, you have to work to pay taxes to older people so that they can retire with all these government benefits. And then you also have to pay for yours as well. And we have to cut the program overall. Like there's just going to have to be some sacrifices. The truth is we're paying too much as the government. They're spending too much and we're not paying into the system as much. So a lot of things need to change. If you look at it from the view of a politician, no one wants to be that person to make the change because they'll just be voted away. But I think there'll be a point where push will come to shove. And there will be a movement to try to change the way entitlements are done. I don't know how that's going to happen, but I think it will eventually happen. In your recordings, could you reduce the person in person? Yeah, I can change around the recordings. Look, I'm not. This isn't ESPN with like 40 camera angles. I'm working with the technology I got. I actually do all of that on the fly. It reduces editing time a lot. So it's not something I can really edit and post, but that's how I'm able to get videos out as frequent as I do with having no staff. Hey, Joseph, I recently found $20K in an old 401k from a job I left 10 years ago. I currently contribute to a new 401k with my current employer. I'm contemplating what I should do with the $20K. Wanted to get your input. Should I transfer the $20K into my current one or convert it into a Roth IRA and invest in something like SCHG? I appreciate any guidance. There's no bad answers between those two. Personally, I just convert it into your current one and then contribute to your Roth IRA. That's what I do. I keep it real simple. Just convert it to your current one and keep it going. Hey, Joseph, from looking at your old videos, can you tell old passive income portfolio was heavily based on dividends? We've had a number of questions go over this. Why transitions from dividends to current investing? I went over this in the previous AMA, so I'm not going to repeat it here. If you want to go over that answer, I went pretty in depth on the previous AMA. Hi, Joseph. I was wondering if you have a deep dive template of some kind of checklist you wouldn't mind sharing with me. Also, could you tell me about how you use AI in your research? I could appreciate if you could send me some samples of prompts you use in ChatGPT. Yeah, so AI is amazing. It's just incredible, but it also can confidently give you the wrong information, like very confidently BS things, and that's what you have to control for. And that's kind of the game. You're more susceptible to believing falsehoods from AI if you haven't dug in and done your own data as well. So that makes the problem kind of double as bad. But what I do to research a company is I learn everything I can about the company, the product, the sales cycle, the dynamics, the margins, the competitive landscape, how embedded the product is, the total addressable market. And how do I learn about those things? I watch videos, I listen to podcasts, I do deep research on on Gemini and ChatGPT, where you just tell it to research different topics. I of course look at the numbers in Qualtrim. I go over all the charts, and I do like charts that go up and to the right. That's what I'm looking for with companies. I want ones that are growing continually with consistency through different market cycles. I read through the old earnings transcripts, and I read through the AI summaries of the earnings transcripts, and any content I can. So it's like turning into just think of yourself as like a sponge. You just want to absorb all information, and that's how you create a vocabulary about that company. Like you're building up a foundation of knowledge. And then the knowledge base that you have makes it so that you can better judge when other people tell you stuff about it. Charlie Munger always said that you should be able to argue the other person's argument that they will bring up better than them before you hold your stance on any subject. So if you take any subject, like I'll just throw out a random one, the right to bear arms, and you're for it or against it, before you have your standpoint, you should be able to argue what the other person's going to argue better than they can before you have your own stance on it. That was his philosophy on anything. And that it's especially true with buying a stock. You should be able to argue the bear case for the stock better than the bears, because you don't want to be surprised by what they bring up. So you need to know the company inside and out, top to bottom and front and back. You need to know it every direction. You need to know the bear case, the bull case, and know what you're buying, because then you won't get filtered out as soon as you hit something a little bit shaky. All right. Thoughts on the game Clair Obscur. Expedition 33, are you playing it? I am not. I don't have any thoughts on that one, actually. I haven't played any of these, so I apologize. I have played some... I've been playing Marvel Rivals. I know that one's like super straightforward. It's fun, though. I'm not good at it. I got up to Grandmaster for a while, and then I fell off because I stopped playing it as much. I wish I had more time to play. I play a couple hours on the weekends. I like playing some games. It's fun to be able to talk with buddies over mics while playing. But I think I'll have a little bit more free time during the summer without the kids in school trying to keep them up all the time. What do you think of Nike and Adobe stock? I'm not going to be in either of them. Again, Nike's mostly reliant on brand value, which is not something I love. They do have deep distribution, and they have an exceptional brand. So it's like really good brand value. Adobe, I think, is just it's another one that's too in the mix of it. It's too exposed to AI competition, keeping their margins when there's so many competitors trying to chip away at their margins. There's just too much to concern with it. I already have some software stocks. My assessment was Salesforce was a bit more insulated from AI than Adobe. I think that's still true. My assessment is that Intuit is much more monopolistic and insulated from AI than Adobe. And I very much believe that's true. So I'd rather invest in either Salesforce or Intuit over Adobe, even though Adobe's cheaper. When I have concerns about the moat of a company, I'll abandon the company. If I really am concerned about the moat or its ability to continue competing and maintain its market share, that's a real concern for me. I think odds are both those companies turn out well, but I like overwhelming odds, just incredibly good odds that it's going to turn out well. Hey, Joseph, can you explain to us why your investment focus evolved from dividend? This is such a popular question. I think I've been asked this question like 5 or 6 times. I'm in my 40s and I still have about 15 to 20 years of wealth accumulation ahead from my W-2 job. Therefore, I believe that a growth compounding investment strategy is more suitable for now, offering higher total returns and lower taxes. At what point in an investor's lifetime does switching to dividend growth focused strategy become more sensible? So I switched to the strategy that I am now in pursuit of it's an alignment of focus. So before it was buying companies that are growing dividends every single quarter, and that naturally leads you down a path of really good companies. Because just frankly, a company can't exist that long, or a company can't be a bad company that grows dividends for like 15 years. It just doesn't happen. You can't do it. It's one of those things that you really can't fake for that long. But I think there's metrics I can look at that are even better metrics to identify higher quality companies. Ever increasing margins with operating leverage and free cash flow growth that's at roughly double the speed of the S&P 500. I think that brings you to even a superior company than one that's grown a dividend for 15 years. I really do. So my angle has always been to invest in good companies, but I'm getting more, more, I would say, biased or more explicit with what I'm looking for. I have an even higher standard than I had before. Now I'm looking for companies that are, top tier of the top tier. And that's why before, when I had dividend growers, there's a lot of companies that grow dividends for 10 plus years. They're not like few and far between. I guess in terms of the total market they are, but in the S&P 500, there's many of them. There's 30, 40, 50 companies that are growing dividends for a decade plus. You don't find companies of the type that are in my portfolio that there's 50 or 60 of. There's not 50 or 60 Costco's and Netflixes. Like, they just don't exist. So I'd say that my strategy overall has shifted to a higher quality company. In terms of how I transition into retirement, that's a whole different question. I'll likely ETF it at that point. I might be a little bit more conservative. I'll move out of stuff like SCHG, more to the S&P 500, maybe have some treasuries in there, more of like a 60-40 kind of, just a bit more conservative all around and a bit less managed. But who knows? It depends on what my priorities are in life. My priorities are to forget about investing and just enjoy life, then I'll do that. But if enjoying life means managing my investments, I'll still do that to some degree. All right, you say, hey, Joseph, I have 2 questions. Apple TV question. Just finished Severance, no spoilers. If you were given the option to opt in for Severance program, would you? And thoughts on the new Discord UI. Okay, so really interesting question. First of all, to anyone listening to this, if you haven't tried out watching Severance on Apple TV Plus, give it a try. I think it's possibly one of the best shows made. It's my wife's, I believe, all-time favorite show. I think it's Severance. And her favorite show before this was Better Call Saul. She loves Mad Men and Breaking Bad, Fargo, those type of shows. But Severance brings it to a whole new level of originality. It is deeply, deeply original, a bit philosophical. It puts you through this frame of mind where you're kind of figuring out what you would do in certain situations. It's a crazy show. It's a little bit slow at times, so you have to actually pay attention. It's really not one that you can be on your phone browsing Reddit or Twitter or whatever it is during the show. You'll just miss really important stuff. So it's not built where it spells out the storyline for you. You actually have to pay attention and kind of tie things together. But Severance is crazy. In terms of whether I would opt into the program, no way. I think first of all, I'm in a situation right now where I like what I'm doing, so I don't want to separate my mind from what I'm doing at work. I suppose if my job was truly, truly just horrible, like it was just awful. For me, even a white collar office cubicle job isn't that bad. It's not bad enough that I would want to go through the Severance program. But maybe if I was like, in a coal mine or something like that, then I'd want to do Severance. But other than that, no. To answer your first question, no. But for everyone else, watch the show. It's very interesting. You might not like it. I'm not saying that everybody will love it, but at least you'll think this is a very, very original show. Other question here, thoughts on the Discord new UI? It's grown on me, like new UIs usually do. As people, we're usually a bit it's like repellent for anything new in the way that we do things and processes. So anytime there's a new change, people go, oh, I like the way it was before, even if it's actually technically better, the new change. In this case, I like the new Discord UI. It's just a bit more modern. There's a bit more padding with inputs and I think it looks good. The colors, I think, are all right as well. I don't mind it at all. I didn't have any problem with it. All right. Sigvard says, Hello, Joseph. What changes would you make to this portfolio? As you can see, it's very similar to yours. What would you add or look to sell? My time horizon is over 30 years and I'm 16 years old. Are you really 16? I don't know the ranges here, but 16 would surprise me only in that less than 1% of my audience is younger than 18. Like quite a bit less than, it's like 0.5% of my audience is less than 18 years old. We have mostly adults in this audience. People that are 18 to 45 make up the core demo. About 90% male, about 10% female, which is not nothing, but it's majority male. YouTube's already skewed a little male, and then I think finance is a bit more, so that just adds up. But overall, the age, yeah, we don't have that many people that are 18 or below. If you're getting started now, though, it's a really good thing. If we look at your portfolio here, and just to mention, this look, I really like it. I don't know what this is from, but we're doing something similar in Qualtrim where we're going to have a vertical bar chart that shows your portfolio. It's going to have your weightings like this as well as your gains. And we will have AI analysis where I've made a careful prompt to look over and analyze your portfolio based on the characteristics of the holdings. And it kind of walks you through it. It has multiple paragraphs where it tells you about the qualities of your companies, the type of commonalities, that type of thing. And it will also highlight the risks specific to your portfolio's holdings, the type of things that you should watch out for if you're invested in these companies. Now, what I'm going to be doing is a series where I do go over people's portfolios. I give you my take on them and how I change them, but it's going to be only for people using the Qualtrim portfolio tool. So we're going to have that new series soon. I think it'll be fun. It's going to be kind of like a Discord exclusive where we do portfolio reviews. You'll just screen cap your Qualtrim portfolio. I'll go over it. I think it'll be a lot of fun. Now, let me take a look at yours. I'll do yours, even though I don't know. This is probably some brokerage or something. S&P Global is the top holding 16%. A lot of companies, I would say, don't have it as 16%, but S&P Global is an elite company, so I have no problem there. It is just diversified, high margin, deeply entrenched, lots of secular growth, very difficult to disrupt, so on and so forth. Netflix, you know how I feel about that one. I think it's very well positioned. I think it's fine having it as a rather large holding. Netflix is a bit at the high valuation range. It's traded with a lot of momentum. So don't feel bad if that reverses a little bit. Like we've been through this before with Netflix. But the thing to pay attention to is the amount of cash flow it produces. And I think that's going to be rather consistent. Then you have MasterCard, Investor AB. That seems like a ETF. So I don't mind having an ETF there. Amazon, ASML, Moody's, Comfort Systems USA. I'm not familiar with that one. Texas Roadhouse, Arista Networks. I like that one. It's a good company that I don't own. Automatic Data Processing. I also like that one. Another deeply embedded company that I don't own. United Health Group. Don't mind that one here as well. I don't like the company United Health Group. I think I've had experiences dealing with health insurance that are terrible, but the stock it's a good stock. It's a good company. Equifax, obviously I like that one. Ingersoll Rand, I'm not sure about that one. And then we have a little bit of Google at the bottom. I like the portfolio. It is an interesting mashup of holdings. There's not anything wrong per se with it. I'd say that there's some that I think are obvious good companies. You know, you have Amazon, you don't have much Google. You know, I don't mind that. I don't see any obvious flaws with this portfolio. I'm trying to find some obvious flaw with it. I'd say that it's very concentrated towards Netflix and S&P Global for a starter portfolio. But if you're in Netflix at 12%, I'm assuming a lot of that is growth. I don't like selling holdings when the position has built itself to a big position by just growing a lot. So I don't consider that a real problem. If it were me and I was adding to this portfolio, like I was deploying new capital, I'd probably be buying more Amazon and more Google possibly at this point. I probably wouldn't be adding to Netflix or S&P Global. Those seem big enough. I might add a bit more to ASML. You already have that one as an 8% position, so I wouldn't build that one too high. I think Moody's is in a great position as well. And Equifax is one I'd prefer to have added to just a bit ago, but that's one I would add to as well. And then there's other companies I'm looking at. I'm looking at Spotify. I'm looking at Shopify. Those are two that I find very interesting. They're at valuations that I'm not sure about yet, but I'm going to be looking at opportunities for those ones as well. But overall, I like the portfolio. I don't see anything to mock here. I don't see anything too wrong. I'd have to look up a couple of them to make sure of what they are. But I think it's diversified. The top three holdings I think are very strong, making up 33% of the portfolio. MasterCard, Netflix, and S&P Global. If you have an ETF as a fourth position, I think that's fine. And then the fifth is Amazon. I think it's all great. So no problems there, man. Very strong portfolio. Obviously, I'm a bit biased because those are a lot of the companies I'm bullish on. But, what can I say? I think they're going to do well. How much cash do you personally feel comfortable holding percentage considering the opportunity cost? I don't hold much cash. I just don't. I have maybe $50,000 in cash at a time. And keep in mind, I'm running a business where I have variable business expenses. So I'm paying taxes. A lot of times I'll have to pay quarterly taxes where my accountant will say, hey, you owe $20,000, $30,000 in taxes. I just paid my developer a big fat check for Q1 of development. So I have these expenses come in and I try to keep enough cash to basically cover those expenses. But I'm not in a situation where at some points I'll have up to $100,000 in cash, but I'm not going to sit there with hundreds of thousands of dollars in cash and have it a big part of my portfolio. I have companies that I'm very confident will do much better than my cash position over the next 30 years. And I consider that a massive opportunity cost. Like, sure, Berkshire can sit in cash, being a nearly $1 trillion company that generates enormous operating income. They've already won the game. But for smaller investors, I think you're always going to be generating new cash. If you're someone that has aptitude, you have work ethic, you have created a network and you've built different skill sets and you know different people and whatnot, and you're in different industries, you're going to be able to generate new cash all the time. So you want cash there in case you get laid off or fired from a specific job to help through that transition. But I don't think you want to go too far to where you have so much cash that you're just sitting there watching the market go up. I think you need to look for opportunities where the market dips to be able to deploy that cash. Do you have a perspective on how the new ESPN streaming service from Disney will impact the stock? With the declining linear television business, converting ESPN to streaming model was a must. Given what we know this week about the proposed ESPN streaming packages, what's your early take on how this will impact the company? I think it's a good direction for Disney. They need to create a more sticky service, meaning that churn or the retention rate of Disney Plus is better. And by them including things like Hulu with FX shows, Disney, Fox, and now ESPN in a bundle, it's going to have a very low churn rate or a very high retention rate, which is good for Disney. So basically, people that sign up for this package are going to be very reluctant to sell it or to cancel it. They're not going to be canceling it because they'll have so much different things that they'll want to watch at a different time that, between the sports, between Hulu shows, between Disney originals, they're just not going to cancel it. It's very similar to what Netflix has done to reduce churn. Netflix just has something for everyone. They have really interesting documentaries. They have stand-up comedies. They have movies and television shows. They have original content and they have licensed content. And between all of that, there's something for everyone. So that's what reduces churn. Whereas you have companies like Apple TV Plus, where Apple TV Plus is great. It probably has the highest quality shows, but it doesn't have something for everyone. Not everybody wants to watch a boutique, premium, elite television show. Sometimes people want easy watching that they can just be on their phone and watch. So Apple TV is going to have much higher churn than Disney Plus. So I think this is a good news. It's necessary. My issue with Disney is that if you look at Netflix, everything's new. They're just building up a new business. They have no old business that's in decay. With Disney, this is a transition from old ESPN to Disney Plus. And Disney Plus with ESPN is going to be like $35. So it's good. It's necessary for Disney. But you have to factor in that they're losing something as they're gaining something. Netflix is only gaining something. Am I reading this right? XYZ or Block has so much stock-based comp that they are burning investors' money. Was looking at the stock-based comp adjusted free cash flow per share. Yeah, you're reading it right. That's what a lot of companies do. I, for a long time, I would just never invest in Block, specifically because of Jack Dorsey. I think the guy is out there in his own world between yoga and meditation and his philosophical ideas. I don't think he's a prudent business manager. I think that he built Twitter, which is great. But you look at what he's done with Block. Just look at what he's done. He's had Toast take, just crush them in market share for restaurants. He has, Clover, all these other companies that are just invading their territory. They have there's so many other payment processors that have chipped away at Block's core market and taken out all these different segments. Well, they're doing what? What are they doing during all of this? They're not creating a lot of value for shareholders. I think the problem with this, I think, is the leadership. I just think they're focused on the wrong team. I would not get behind the company myself. What are your views on serial acquirers with good track records, Constellation Software, Roper Technologies, and these type of companies? I see them as gaining popularity on the Discord. Are you and our favorite by some investors? They're not my favorite. I don't love them. In fact, I've moved my portfolio in the opposite direction. The only serial acquirer I had left in my portfolio was Vici. Vici grew by series of acquisitions. But every time a company grows by acquisition, they have to dish out money or they have to dish out equity. In the case of Vici, they had to raise shares and dish out equity. It was accretive. They make money doing this, but they have to give something up for that growth. And if there's competition for what they're buying, if there's new people bidding on what they're buying, the discrepancy between what they're paying and the true value of it gets less and less. For example, it's basically like the market in which they're doing their serial acquisitions in. If that market becomes more efficiently priced, that's a problem for these companies. So with Vici, it was very inefficiently priced when they first started doing this and was buying up the Vegas Strip. But then over time, you had other people get into the game of experiential property like Realty Income Corp. Now they had further competition. The bids became more efficient. And the value proposition to Vici is less and less. You can see the same thing with Constellation Software. They write checks, they acquire different businesses, they normalize the process, they implement best practices, and then they make money doing that. But if BlackRock and other companies start to, pick off a few employees, figure out how they're doing it, bid for the same type of companies, you have yourself a more efficient market and they don't get as good of gains. What I'd rather have is instead of a company that needs to pay for growth through stock or equity, I'd rather have a company that grows organically by word of mouth, by virality, by pushing out their own products, which cost them far less and have far more flexibility and control over. For example, you can look at a company. I can give a couple examples. You have Costco. Costco builds a single warehouse. So they paid somewhat for growth, right? They might pay like $100 million or whatever it is, couple $100 million for the warehouse, the property, all that type of stuff, all the costs with building a single warehouse. But then that warehouse, it just organically grows forever. There's Costco warehouses 20 years ago that are still gaining foot traffic and still gaining in revenue every single year. And that's a very established, predictable, forecastable investment. They're not acquiring a new type of warehouse every time that they don't fully know what the returns are going to be. The other people are bidding for that. They own that IP. They own the IP of their warehouse, how it's done, how to do it. They have all the learnings from all the previous ones that they've done. And I just think it's a far more predictable way of doing business. A better example is even more organic growth is S&P Global. If you look at their credit rating business, they have a tax on the growth of all global debt. So as the economies of the world grow and issue more debt, S&P Global just makes more money based off of other companies' growth. They don't have to pay for that growth. They don't have to dilute shareholders. They don't have to issue shares to raise capital. They don't have to put up cash. They just grow as a result of other companies growing. No acquisitions necessary. Now, these companies might do tuck-in acquisitions from time to time, but I like the business model of these companies that have more control, more predictability in organic growth. Hey, Joseph, love what you're doing. I listened to the recent Chris Hone interview and was struck by how much he seems to like GE Aerospace. It's an interesting and complicated company, but the thesis is akin to my thesis on ASML. Complex machines, not many can make, but they're in high demand. What are your thoughts on GE? Might be a fun topic for an exclusive. I think so too. That's basically it. That in this space, he says, like in the past 50 years, there's been no new entrants of new companies that are making these products because the barrier to entry is so high. It is similar to ASML. Creating these advanced machines is very technically difficult to do, capital intensive, knowledge intensive. It's a very long path to get to where they are, and that's why he likes the business. So it's basically like replacement costs. Like if we wanted to replace GE, and I came to investors and I said, hey, I want to build a new GE that makes these jet engines. How much time will it take and how much will it cost to do that? The number that I would be quoted would make it not worth it. It would be easier just to buy from GE. So that's the moat. Is it's basically just mathematically not worth it. It's easier just to buy from GE, and that's why no company has done it. All right, you say, hey, Joseph, I was wondering if you still use as your appropriate free cash flow yield or PE multiple guide the Michael Mauboussin research paper. It's pretty obvious that fundamentals can change drastically the multiples. But do you use your qualitative research as confidence and conviction in your growth assumptions in the Michael Mauboussin multiples, or do you base your multiples completely in fundamentals and historical multiples? Just asking because when you calculate intrinsic value, the difficult part you need to get right is future multiple, not the appropriate present one. When I say the appropriate multiple, that is what I believe the future multiple will be. And appropriate means what I believe this company deserves should be the multiple. Not what it currently is, or if there's some temporary issue, I think the multiple should be lower. No, it's what I believe the company is actually worth fundamentally based on the qualities. Now, the Michael Mauboussin paper, for those of you that aren't familiar, the one that he's referring to basically says that if a company has higher returns on capital, meaning that they can attractively reinvest money and make a lot of money from it, those companies deserve higher multiples. And if a company has higher growth rate and a high return on capital, it deserves a very high multiple, very, very high. If the returns on capital are bad, or if they're negative, for example, if a company invests $100 into itself, and then it makes $90 from that investment, growth actually hurts that company. So if you have negative returns on capital or very, very low returns that are lower than the cost of capital, growth actually harms those companies. The faster they grow, the worse it is. So you want companies that first and foremost have high returns on capital employed. That's why I don't invest in car companies. That's why I don't invest in telecom. That's why I don't invest in these, a lot of these airports and airplane companies, that type of thing, because those have low returns on capital. So it doesn't matter how fast they're growing. They can grow fast and that's bad for them. They grow slow, it doesn't matter. They have low returns on capital. They can't effectively reinvest money to make shareholders money. So I invest in companies that have very high returns on capital employed. On the Qualtrim charts on Insights, the gauge for that is under the ratios where it says returns on capital employed. You want to look at that on the annual tab, and then you also want to look at it and make sure it's somewhere around 10% or above. You don't want to invest in companies that have below 10 to 12% returns on capital employed, unless you really believe it's going to go up over time dramatically. Now, having said that, do I use this paper? Not really. I don't use the exact formulas he gave because they're very theoretical. The reason that I brought up the paper was to illustrate the point to the audience that a 30 PE company is not more expensive than a 20 PE company if the returns on capital are way higher for the 30 PE than the 20. For example, if a company is trading at a 30 PE ratio, but it has a consistent year-over-year 25% returns on capital employed, that company is cheaper. It's cheaper to buy today than a company that trades at a 19 PE ratio that has year-over-year an 8 return on capital employed. If it earns 8% back per year. The company that's cheaper is the one that's trading at a 30 PE that has a 25% return on capital employed. And that's because that one is generating wealth every single year. Therefore, it's further justifying its higher multiple. So that's what he's talking about here. And I think that that point needs to be said for many value investors that are only looking at PE ratios, not factoring in other important things that add context to that PE ratio. So that's the reason I did it. It was for illustration reasons. But the way that I use the DCF calculator is I believe that you can look at your companies in terms of total quality. So like within my portfolio, I have a hierarchy of quality even within my own holdings. I've said it before, S&P Global is a higher quality company than Texas Roadhouse. So the calculation changes. S&P Global, the appropriate multiple they should trade at should be different, and you should have different rates of growth for them and different things to justify their valuation. The appropriate multiple is based off of all of that quality plus the growth rate, and then I assess what the multiple should be. So if a company is very high quality and it's growing very fast, very profitable, high margin business with fast growth, fundamentally strong, very wide moat, secular trends for long periods of time, that deserves a higher PE ratio or a lower free cash flow yield. It deserves to trade at a higher valuation. If the market is not giving it that high valuation, it's undervalued. So that's how it's a judgment call, but that's how I come up with the appropriate multiples for the companies. Whereas, of course, if a company has a very weak moat, growing slowly, tough business, then it deserves a much higher free cash flow yield, a lower PE ratio. It's one where you need to get an extreme discount to even make it partially worth it. And in those cases, I typically don't buy them altogether. All right, we'll do a couple more here. Joseph, love your calm, methodical reasoning. Honestly feels like listening to Jerome Powell if he had a growth portfolio and a YouTube channel. Just wondering, when are you launching the Carlson Capital Management LLC so we can all wire our life savings? Hey, you don't need to do that. I show everything publicly. You can take my research, you can consume it without paying me a management fee. If you feel like, hey, I'm getting value out of this, I enjoy his content, I want to contribute, the Patreon, $10 a month is great. It's not the reason I price this $10 a month is if you do it $5 a month, it's really tough to make money because the processing fees can in some cases make up around $2 to $3 per month. So that takes over half your money just to process the payment. At $10 a month, you get past those processing fees, you still get the majority of the money, and it's not enough money to detract from people's financial well-being or to detract from your investments. There's competitors of mine that price their Discords and their private communities and that type of thing at $100 a month, $250, the multiple hundreds of dollars per month. But I think that's a real tax on their customer. That really does eat away at their financial future. That money compounded over time. $10 it's just not enough to move the needle. $10 a month. Like that's just not enough to really detract from your financial future. And hopefully you're getting more value than that. So, if you want to pay me back, so to speak, if you really enjoy the content that much, the Patreon is the way to do it. It helps me out tremendously. Hopefully it doesn't detract too much from your life. It's about as low as I can go and still make it feasible where not all the money's just going to payment processing. Hello, sir. Can we please have a poll option back? I really like that one here on the Discord. We can. The problem is a few people, this is the issue. There's a couple people that ruin things for everyone. So there's a few people that were just they're spamming polls in general. That's why we took it away. There's just a couple people making poll after poll, silly poll after poll. And we go, okay, we're gonna take it away because they're doing that. Maybe we'll just say stop doing that and time out the people that do that. I'll talk to the mods about it and see what they think. Hi, Joseph. I've been a member for a few months. Great content. I did not see any other super investor that you showed had a position in NDAQ. I don't think I have a position in NASDAQ either. Isn't it likely a toll booth too? What is your opinion on this? Yes, it is. The question is it the best toll booth? There's a lot of toll booths to invest in. Not a lot, but there's a number of good ones. You have the Apple App Store toll booth with 2 billion devices. That's a good toll booth. You have Moody's and S&P Global. You have MSCI as another option to NASDAQ. Why wouldn't you buy MSCI? That's kind of a toll booth. There's companies that have to list, basically every company outside of the US lists on MSCI. So there's a lot of options there. What you need to do is put together a list of toll booths. Put together a list of them as a watch list on Qualtrim. Then you have them in kind of the front of your mind. Every company that has these type of toll booth type of monopolies, right? Like Visa, MasterCard, S&P Global, Moody's, Apple, and then you can kind of gauge which ones you really think are the best investments, which one will make you the most money over time. What do you think of hotel companies like Hilton, Marriott? Do you ultimately prefer Booking more? And if so, why? I heard that these hotel companies franchise and brands cut out across the world, so it doesn't seem like they're the same diversification and scale as Booking. Well, they're much more popular in the United States. These companies don't operate and have a big presence in Europe. Whereas Booking is much more popular in Europe, doesn't have as big of a presence in the United States, or at least as much pricing power. But Booking is certainly more global. So it's harder to avoid Booking than it is to avoid Hilton and Marriott, because Booking, it's just everywhere. You can book trips everywhere with Booking. I like Booking more because Hilton and Marriott are more of a licensing play. It's a bit like investing in a Wingstop type of situation where the restaurants, it's a franchisee model. It's a bit more like that. And I like Booking as just the owner of this platform, technological platform that has huge dominant global presence. I think both are really good, but I do prefer Booking's business model a little more. The only concern I have for Booking, and this is something that's kind of on my mind with Booking, I'm looking at it, which is simply, how is AI fully going to affect this? We see every demo for AI companies that you can book a vacation, right? So AI is getting a lot better at that. You could have AI go out and search different listings for hotels and directly book and that type of thing. So there's some discussion of how that will work. I'm going to be looking at the usage statistics that Booking releases. Are they gaining more app users or losing it? Are they growing in volume or losing it? Because if I see signs that their moat's getting eroded by that, then that's going to be a concern. But as of right now, I haven't seen any signs of it. It's just a thought, something I'm going to be watching. All right, let's take a look here. I'll do 3 more questions and then we'll end it there. Hey, Joseph, appreciate all the great content you put out. Thanks. I wanted to ask about, how did you build a solid base and accounting aspect of investing? Did you do a course book, dove straight into 10Ks and Qs? Do you have any opinion on CFA, Chartered Financial Analyst certification? I have a background in tech and I'm switching to investing full time. Yeah, I didn't do any of that. No courses, no books. All of it was online, learning from Discord and reading, a lot of reading. So I guess not books per se or courses, but just lots of looking stuff up and reading. Everything is online. Everything's on the internet. So you can learn all that stuff there. You do not have to become a CFA. I would only do that if you really want to have the certification. Like if that's gonna benefit you. If you can look at yourself now and say, having that CFA title will make my life better somehow now than it was before, then I would do it. But if you just want to learn what a CFA learns, you do not have to do that. You can actually look up CFA exams and see what they're being tested on, and then test your own knowledge against that. Now, I've done that before, and basically where I stand is when it comes to equities, I'm very, very knowledgeable. When you get into fixed instruments and bonds and some of the crazy stuff you can do with that, that's where my knowledge falls off. But that's not because that's because I'm not interested in that aspect of it. So I wouldn't enjoy doing the full CFA thing because I'd be forced to learn about a lot of aspects about finance that I'm frankly just not interested in. I'd rather be very, very good at equity analysis than, fixed income analysis. That's not something I'm just interested in at all. So you can do that. I think it'd be fine. But there are ways to learn all this stuff online. Just test your knowledge. And yes, I definitely have read a lot of 10Ks and 10Qs. So that's something that helps out as well. I've dug through so many financial statements too. I think you just look at financial statements more and more and you get more familiar with them, what different companies do. So that's been something that's been a learning as well over the past 6 or 7 years, just tons of financial statements. They're actually fun when you get it down. It's confusing at first, but if you start to learn this stuff, it's fun once you get it down. The internet's out there. You can learn any subject. Don't limit yourself. People have this tendency to put ceilings on themselves or caps on what they can learn. You can literally learn any subject on the internet. All the info's out there. Just go through it. Let's say you were going to go into a coma tomorrow for 5 years. Would you be happy with the stocks you hold? Very happy. I would not change a thing. So I've been asked this question a couple times, and I could confidently say I could go into a coma tomorrow, come out in 5 years. And I think my current portfolio as it stands right now today will be worth significantly more. My guess is close to 2 times as much. My goal is to have it be worth twice as much. Why do I think that? I think Netflix will be close to $900 billion, trillion dollar market cap. I think Costco's just going to keep trucking along. People will be impressed with the sales. I think that Texas Roadhouse will open up more restaurants. I think Amazon and Google are way undervalued right now. They'll be $300 per share, so on. It seems dreamy. It seems unrealistic, but that's how a lot of that stuff is. When Microsoft was $220, I was saying it was worth $350, and that sounded a bit crazy. Yeah, look where it is now, right? That was only a year. So it could be before 5 years, but I think in 5-year timelines. That's how I do my analysis. I think in terms of moat, I think past 5 years, but in terms of pricing, I think 5 years. So moat and terminal risk, I'm thinking 20 years. Pricing, I'm thinking every 5 years. How do I grow this portfolio? Double what it is now. All right, last question this time. I have recently, like everyone else, watched United Healthcare drop. It looks like a good buying opportunity. However, I do not feel good about investing in a healthcare company of that nature. Do you ever draw a moral line around certain industries and companies? I do. I do. Now, luckily for me, most companies that I'm morally against investing in are also just materially and objectively bad investments by my judgment. For example, I wouldn't invest in a pure tobacco company. And I have absolutely nothing against people that smoke. No judgment from me. But everybody that smokes knows it's not good for you, right? So it's not telling them anything new. We've been told this a million times. And it's a product that I think it's just not good for society or people. It damages your lungs and your hearing and all sorts of different things. So it's not a fun product. Like I just don't want to put money. I don't want to support it. I don't want to put money behind it. When I'm in a business, I do feel to some degree like I'm not just some passive person riding along, but I'm actually capitalizing the business. I'm helping it. I'm investing in it. I want it to be profitable. I want it to be successful. So if there's a company that I don't care for the industry, or that I think the product is not healthy or just good for people, then I don't really want to put money behind it. That doesn't make sense, right? I don't think I'm saying anything crazy here. So I hope I'm not saying anything too notable here, but there's some industries where I just go, I don't want my money working behind this company. I just don't, I can't be a proud shareholder of it and really be like, yeah, I'm so glad this company's growing earnings 20% year over year. Look at how many more kids are smoking now than there was 5 years ago. Their marketing campaign's really paying off, right? They converted a lot of teenagers and now they're whatever is the legal age to smoke. I don't even know. I don't pay attention to any of this, but I don't want to fund their marketing campaign to get more people to smoke. So that's one industry. And I could name off a bunch of them, like Herbalife, right? There we go. Another one that is just a product that I don't want them to be successful. Multi-level marketing scheme. A lot of the ways that they grow is they force kind of people that are selling their product to buy lots of it to maintain certain status symbols. They've expanded in Mexico. They rely heavily on people that don't have financial know-how. These less fortunate people in Mexico are trying to make a living. They're trying to become a business owner. These companies, they latch on to that urge of the hardworking people to try to create their own business, and they exploit them and take from them. And I think that's just such an awful business model. I would never want to make money with that company, even if it was a great investment qualitatively, and I knew I was going to make money with it. I would never feel good about it. So there's certain companies that I would feel gross making money from. And these multi-level marketing schemes that extract money out of people that are trying to better themselves are definitely one of them. So there's a number of companies like that, and I could literally list off a bunch of them. And luckily, there's so many companies that are so much better that although they have their flaws, they offer great value to customers. They don't exploit their customer. They offer products that people can. You look at Netflix, okay? The worst thing Netflix does is create woke content. Like, that's the big criticism. Oh no, they came out with this woke show. They have, this doesn't politically align with me. Okay, they have a wide breadth of content, stuff for everyone. Netflix operates in a very consumer-friendly way. Month-to-month only billing. No annual contract, no locking in people. A product that is cheap, easy to cancel, 2 clicks to cancel it. Extremely consumer-friendly billing. There's no tricks or gimmicks to what they do. They offer immense value at a cheap price that's very easy to get out or in of. So I feel like that's a company that operates very honestly. They also go above and beyond. For example, if you haven't used your Netflix account for over a year, if you haven't logged in, they automatically cancel it. They don't continue billing you. And they do so because they only want people being charged to be people using the service. Now, they're not legally required to do that. They're just doing that because they want to operate a forthright business. So, yes, there's lots of companies like that I make some judgment calls on where I want my money to work because I want to be in businesses that I do think are not making their money in a bad way. And I also think that companies that make their money in a bad way, for the most part, don't turn out too well. Again, another one is like the ticket companies, Ticketmaster and all those. It's tough to invest in a company that people don't like. Now, in terms of United Health Group, I would not put that in the same category as like an Herbalife, in that it's the way that I view United Health Group is I have a very negative view about the company, but that's more a negative view about the entire industry, the politics behind it, the way our entire system's set up. So my issue with like blaming all of this on the CEO of the insurance company is he didn't create the system. The guy did not create the way that healthcare operates. He was just plucked and put into a job for a few years. So that's why I think taking everything out on the leadership, I don't think is the right approach. This is a problem. The US healthcare is a problem created by Congress, created by private companies, created by politicians, everyone in between. I mean, it's just a huge problem, and that's why it's so difficult to fix. So although I don't blame uniquely United Health Group, I don't like the industry. I don't like the company. I don't like investing in a company that's so widely hated. Just basically all their customers, the public, politicians. Like nobody really likes it. And then I've had personal experience where I have felt like for lack of a better term, I use it a little broadly, but I feel like I basically got scammed out of my money with health insurance. It is just like a company like United Health Group. In fact, I can't remember which one, but my wife signed up for health insurance coverage. The person basically relayed to us, the person that was helping us sign up for it, that it would cover certain things for my kid. He has very specific food allergies. And then when we ordered the product, they billed us and then said that it wouldn't cover it. And we have to pay it, otherwise our credit gets shot. And so we paid for the health insurance, which we were on a private plan. We paid for this health insurance on the premise that it would cover these specific things we were ordering that we were told it would cover. And then they sold us a policy that didn't cover it. And since we didn't look through the policy with a fine-tooth comb, like a lawyer, we didn't catch it. So we're the suckers that got sold something, paid for it, and then we got the product, and now we have to pay $1,000 for the product plus like $800 a month we paid for 3 or 4 months for this health insurance. Just money out the window that we're never going to get back. So that's my experience. I agree with everybody that has gripes about it. I still don't think the CEO, as frustrating as those experiences are, I still don't think the CEO alone is responsible for this. I just think it's a huge problem with the way these companies operate. But yeah, man, to answer your question, there are companies, very much so, that my distaste or dislike for their product or the way that they treat their customers does impact my vision, my investment decisions. And I think I can have a extremely good portfolio full of companies that operate with integrity and they offer good value to their customers. They have good relationships. I can construct a very, very strong portfolio. In fact, I would put my portfolio up against anyone that invests in companies that do business the other way. I think I'll have much better returns. Now, that's going to be all of it for now. Hope you enjoyed the AMA. I'll see you all in the Discord.